So maybe, I don't know if I want to call it a horror story, but maybe you could speak to an example, you don't have to mention any names, where you say, probably wasn't a good way that they went about doing this, or it could even have been an opportunity that, unfortunately went south. Now, this next question, popcorn style, anyone could jump in, and hopefully multiple will jump in. So maybe, I don't know if I want to call it a horror story, but maybe you could speak to an example, you don't have to mention any names, where you say, probably wasn't a good way that they went about doing this, or it could even have been an opportunity that, unfortunately went south.
Yes, I have a story. So we invested early in this company called Rebel Systems, and they really were the next big thing. The media said they were the next big thing. The founder there's two founders, one is a woman, one is a man. The woman is a CEO, and in public relations, you're manufacturing the news, so sometimes founders read it, and it was the height of fundraising. And it was brought to my attention that she didn't want to go out and raise money at that stage because she felt that she was going to get a higher valuation as she closes this other deal. And the company is going to be much more valuable. And so many people around her try to explain to her, well, the market is here right now. If it changes, it's going to crush your valuation. Oh, no, you don't understand this and that. I understand. I agree with you. Try to agree with the founder always. Unfortunately, the market did change. The valuation was close to $1 billion, went to $350 million. The board, unfortunately, blocked her from getting funding because they wanted her off the board. They wanted the other co-founder off the board. There was no other option, especially at the later stage of Series C, the big checks. And they raised money from a private equity firm out of New York. I don't want to say their name. You guys can research it. And their motto is to take a company and kind of think of it as a corporate raider, chop it up, reduce the staff, and turn around and sell it to make a profit. Nothing wrong with that, but it's not for early investors to something that we want to hear. So the only message that I'm trying to communicate, she did get a big payout, he got a big payout, the company went on to be acquired, less than what we expected, $250 million. And the message that I remember there is, don't believe the news. If the funding cycle is hot, that's the time to strike. Not sit back and look at trying to build your business better, because you can't control the market. Once the market changes, the market changes. And that's one thing that I would suggest to founders, if there's a frothy fundraising time like right now, yes, work on your business and block out time to reach out right now and see what you can. Because valuations, from my experience I'm not only an angel investor, but we had a fund for 10 years, ups and downs, and no one sees it in the news. Valuations are high, which is, think of it as the value of a piece of real estate. Then it goes down and it goes up and it goes down. And it's not really based on any third-party data. It's based on investors deciding what percentage they want to invest in. So if you can get the money, get it now, because it always changes. Thanks.
I'd like to answer that on a broader scale. We've had a lot of horror stories of companies that didn't make it. We also have a lot of companies that have come through that claim that they would exit in 3 to 5 years, and it's been 8 years, and my money's still with them, and all the executives are making good money, so they have no reason to want to exit anytime soon. So we pay more attention to those exits. But one of the most horrifying things for me is coming to an event like this, or events that we put on ourselves, and having an entrepreneur come up to me and introduce their company and go into a 30-minute spiel, or what they plan to be 30 minutes. They've lost me after a minute because I have no idea what they're doing. So my advice to all the entrepreneurs, keep your stories short. And like we're talking about, we're trying to keep our answers to 2 to 3 minutes. The only way to really capture somebody's attention is to know what you're talking about. And if you can't say it in 1 minute, you don't know what you're doing. So try to keep it short and sweet.
Great message. Dr. Kerwin?
Sure. The example I'll give is someone who actually was in Key Biscayne. We were down there and had a nice sounding deal. And the problem with investing at our level is we don't have the resources to do background checks and the diligence that some other people can. And just to make a long story short, the deadline was going to be January 1st to invest. And so I hurriedly called up another member of our group end of December. And the sponsor had told me, call that person for an endorsement. And they didn't endorse. Moreover, they had taken a look at a number of records and actively discouraged me from investing because a lot of the information wasn't correct as they were representing it. So I'm glad that I kept out of that deal.
Excellent. Wyatt?
Yeah, sure. One of our prominent members, I'll save some names on that one, but invested as a gap funder on some real estate out of state, and all the paperwork was done basically for a Tennessee LLC, a Tennessee entity, right? Mm-hmm. But the state that was invested in was New York. And that's completely different legal structure, right? And so you don't, I think Joe mentioned it earlier, right? Is that when you have to do the due diligence on what the local municipality, what the state wants. I have constant conversations we do with, my co-director Jennifer and I have constant conversations with people that need to know about the lunches, right? If you're looking to do some development, you talk to the council member, and in Nashville area, you go to a lunch and they tell you what they want. And maybe they don't like vinyl siding, and they'll tell you very quickly, that's not what we want. Okay, sounds good. So don't put that in any paperwork because I have to sell it for you later on in front of the council. So those kinds of conversations are super important. If you don't know, it can cost you some money. So there you go.
Excellent. That's a good message, Wyatt. And I'll say cleanliness of the documentation. I've reviewed thousands of private placement memorandums and operating agreements as we hold those documents as a custodian. We don't do due diligence, but I look at some of these documents and I'm not in a position to tell someone not to make that investment. But when I look at a document and there's, spelling errors, to me, that's a huge red flag. Again, I can't stop people from from making those decisions, and maybe it works out. But if it doesn't work out, weren't there red flags from the very beginning? Richard?
Yeah, I think just real quick, maybe when people are thinking that saying that a deal is guaranteed, which is kind of illegal to say unless you have an insurance product that is licensed and actually is guaranteed, it's a sign that they're brand new to the game. Sometimes it's someone who's never raised capital and they're trying to raise $1 billion or $200 million, or they're trying to raise capital for 6 different deals, and one is a pro sports team and one's a huge building for $1 billion ground up development and all these different things that'll probably never happen. Some people pull it off, like Steve Schwarzman, founder of Blackstone. He raised $1 billion fund, but he came out of one of the biggest banks with a big reputation. Michael Jordan wanted to play pro baseball. He didn't go straight to pro. He had to play in minors, work his way up. And that's Michael Jordan's work ethic and talent. And people entering capital raising think they're going to go to the major leagues and knock out multiple $100 million, $1 billion deals with zero experience. And they learn the hard way that doesn't work too much. So people that overpromise, promise the moon, don't leave themselves room to overdeliver. And they start way too high, and they should start smaller and grow organically much of the time.
And I'll add one quick anecdote. My background is in real estate. I've been doing it for over 20 years. And a lot of you have heard me talk about it. I do a lot of self-directed Roth and HSA deals in real estate, private money loans, a lot of the types of opportunities that you probably work with, Wyatt, with local investors in Tennessee. I'm from Ohio, though. And about 2 years ago, I had an opportunity to invest in a startup. And it's an AI-based educational company. I got really excited about it. I've never done any investing outside of real estate. You guys know where I'm going with this? It's going terribly bad. Terribly bad. And so that was my lesson. I think I needed that lesson, that I'm very good in specific areas. I have very specific lanes that I follow in. And every time I deviate out of that lane, it always ends poorly for me. I'm the most technologically declined individual. I know nothing about AI other than what I've learned at this conference so far. So why do I have any business investing in that area? Now, if I start to develop a team and educate myself more, maybe I'll have a little bit more confidence and I'll have a little bit better track record of being able to do that. So again, that's my story.